President Ramaphosa recently said that he was baffled by claims that BEE harms growth. Help us understand how you evaluate the president's claim from a kind of micro level perspective, and let's perhaps just elaborate a little bit. We don't have to go get too sidetracked by this, but when we talk about this idea of growth, economic growth, and so on, people might have GDP in their minds, or they might have some sort of reference in their minds. You like to think about growth and a progressing economy is something like solving problems, and solving more and more sophisticated problems is really what constitutes kind of economic progress. So we speak to that a little bit, but then I'd really like to zone in on this claim that BE does not harm the economy, because at a sort of corporate finance level, from the bottom up, you get a front row seat to just what these kinds of equity requirements actually do and how they are so harmful. And I'd like you to elaborate on that, please.
Sure. I mean, I'll start off by saying that I don't believe Ramaphosa for a minute. He may not be the brightest tool in the box, but even he is not so stupid as to honestly be baffled by the claim. The claim is almost self-evident, and the mathematics is not difficult. If you just take the position of an entrepreneur or an investor contemplating putting capital behind a new venture or into the expansion of an existing venture, right from the beginning, the government is taking 40% of the upside in the form of the corporate income tax and either dividend withholding tax or capital gains tax. So 40% of the upside is gone. And then in some industries, you have a situation where the entrepreneur must further part with another half of the remaining income. And that puts them in a position where they're taking all of the downside risk
through a BE
transaction. That puts them in a position of taking all of the downside risk and only having about a third of the upside.
Let's just be really clear on why typically a BE partner is not expected to essentially foot the downside risk.
Yeah, and in one way or another, they are normally funded into these positions. They're not bringing their own capital to buy the shares at market value. There's some kind of funding arrangement, and no matter how you slice it, ultimately that downside is not really borne by the banking system or something like that. It falls back onto the entrepreneur. I mean, there are even provisions in the code if things don't work out and the BE partner, in inverted commas, is not really a partnership relationship, but the BE partner turns out not to make any money, well, then you have to do the whole thing all over again. And if there isn't a transfer of value to the BE partner within a certain specified amount of time, then that's a problem that you have to now solve as the entrepreneur.
Now, some people would say, okay, what about the case where a black equity partner actually brings capital to the table? So they're not funded through a debt structure. They actually bring capital to the table. They're a partner that adds some value at a board level and so on. And there is still the problem that once you are empowered, if there are losses, your company
loses its ratings, basically.
Yes, but the black entrepreneur now, all equity holders now need to bring capital to the table to plug holes, to recapitalize the business. But there remains now a statutory requirement that shareholder or a black shareholder is restored to a particular percentage because the once empowered, always empowered idea has kind of fallen away, hasn't it?
Yes, that's correct. It's not really, it's honored in the breach.
So in other words, if a black shareholder has 30% of a business and the business is making profits and things are going along and the profits are perhaps paying for this debt structure that was used to finance this position, now you go into a crisis situation or maybe some big depression or market downturn and there's big losses to plug. Equity holders are going to be required and asked to bring capital to the table to fund those losses. At this point, there is very little incentive for the black shareholder to necessarily bring more capital to the table because there's a kind of statutory requirement that shareholding needs to get restored.
Exactly. They tend to be very fair weather friends. Yeah. And of course, before we even contemplate difficult situations like that, just for starters, when you reduce the concentration of ownership of an emergent firm, of an SME, you're doing something to that firm. You're harming that firm. The alignment of interests and focus on having active owners in businesses who are continually working towards improving the value of those businesses by serving customers and suppliers and employees and so on better is essential. It's a core part of the sort of the whole potential of economics, not just we can say of capitalism, but it's actually economics. That's if you are reducing that focused ownership, then that has a deleterious effect all of its own.
Yeah.
And it's this incorrect mindset is really embedded deeply in the heart of the whole socialist trajectory. There's this notion of the commanding heights, as if the occupation of a seat on the board of directors is what counts, and that's what's going to allow you to generate a lot of value for yourself. And that's it. Those guys out there, those captains of industry and those fancy shareholders and directors, they only make money because they're lucky enough to occupy the commanding heights.
Yeah, and therefore they're empowered.
They're empowered. Yes, yeah. It's all completely arse about face, because the reality is that value is created in the world by one mechanism only, and that is by solving problems, as you correctly referred to. And in the face of complexity, problems aren't solved by sitting down and performing some calculation by some feat of deductive or inductive reasoning. They're solved through a process, a very, very evolutionary process, a process.
Iterative.
It's conjecture and criticism. It's trial and error. The sort of notion that business strategy is formed by one clever guy sitting in a room and coming up with a PowerPoint presentation, solving the problems that beset a particular company in a given industry, that's a real caricature, and I think it only really exists in the retrospective and highly rationalized memoirs of retired CEOs and in the textbooks of business schools. But the reality couldn't be further from the truth. The reality is that when you're sitting in any given business, you do not know how to solve its problems. That you don't even know what the problems are to start with. The real world is murky and complicated and continually in flux. And so strategy is much more, as you said, iterative. It's much more
almost experimental at times.
Oh, yeah, very much so. It's much more reactive. And it's the successful entrepreneur, the successful investor has to be, first and foremost, a problem solver. And so when you're in the seat, you are the problem solver, and you make money if you solve problems, and you lose money if you don't. It's not a question of being empowered to occupy a seat in the commanding heights. And so you have the language almost forming the incorrect perceptions about what the role entails. And I've seen that so many times play out when the BE partner appoints somebody to the board and they think they're there for the purposes of making sure that other people like them occupy seats like theirs. That's called transformation. And the emphasis on problem solving isn't, let alone the lack of emphasis, it doesn't even enter the room, And that's why that sort of entrepreneurial flair, the value creation mindset is quite easily disturbed by the introduction of shareholders who do not see it as their primary objective to solve problems for the firm that they are fortunate enough to have shares in, So that's the sort of, I would say, is actually where the core of the problem is. All of these downstream financial consequences of putting people into upside-only positions they're also material. But the real problem is the withering of the entrepreneurial spirit, which comes with the mindset of the socialist, the commanding heights mindset.
So this entrepreneur now faces a kind of tricky asymmetry where he's forced to take on partners. If things happen to go well for a while, there's some funding, inherent sort of funding mechanisms. But if they go badly, there's a sort of asymmetrical burden that the entrepreneur or the other capital allocators must bear.
Yes.
That seems to get compounded by certain tax laws. There's kind of taxation asymmetries around capital gains and losses. Losses are not as easy to kind of
you have to have some profits to offset them against.
To offset them against. So there's these asymmetries. So we could think of all this as taking place in a sense on the these are balance sheet kind of dynamics. But what is the net effect of this, Nick? Is it something like the cost of capital goes up? And what does this ultimately do for investment levels? Because we have people lamenting the stagnationary kind of investment levels. Certainly sectors like mining, this has been, there's been famously little investment over the last number of years in something like mining, a sector heavily beset by BEE demands and requirements. So just tie this in a bow in terms of the net effect on capital investment when you create these sorts of incentives on the balance sheet.
Okay, so the effect is this is not marginal territory. The effect is extreme. You are talking about situations where you screen out possibly upwards of 90% of the available opportunities, or contemplated opportunities. And the reason for that is if you're in this dynamic where instead of retaining the majority of the upside as an entrepreneur and possibly contemplating projects with expected returns of 20% or something like that, now you're only retaining a minority of the upside. That potential return has to be much, much higher, a multiple, maybe north of 50%, 60%. And the stock of projects or potential opportunities that affords returns of that magnitude is really small. It's this tiny subset of the available projects that entrepreneurs should be applying themselves to. So it has the effect of completely freezing private capital formation. And I'm not at all worried about foreign capital investment. That's a complete sideshow. And it never ceases to amaze me how journalists and politicians all think in terms of, the capital must come from outside because we're poor and we are a small little country. No, there's plenty of capital, plenty of energy inside the country. It is the private capital formation inside the country that completely freezes up. And that's why you have no job creation, because that stock of entrepreneurs solving problems and thereby generating growth is just substantially reduced or eliminated.